CashCalc calculates all the relevant exit taxes and 8-year deemed disposals on any insurance bonds, UCITS and ETFs added into a cash flow. All contributions into an insurance bond will have the 1% insurance levy automatically applied, but CashCalc also provides the functionality to remove the levy if not applicable to certain contributions. So to see how this works, if we go into CashCalc, we've selected a client, Sherlock and Edith, select the Cashflow tab, inputs and timeline, savings and investments. If we click on the Add Savings and Investment pot, we're going to call this pot Zurich Insurance Bond. What's the category? Obviously, this is going to determine the tax rules associated with any money taken from the pot. So we're going to assign this as an insurance bond. Who's the owner? It can be Sherlock, it can be Edith, it can be jointly held. And again, that will adjust the tax calculations under the hood. We're going to say this is Sherlock. How much money has been invested in total to date? We're going to say it's 100,000. Over how many policies? Commencement date is going to dictate the 8-year anniversary deemed disposal. So we're going to say that's 2015. Starting pot value, 130. So the system automatically knows how much gain that's been had for this particular pot and how much deemed disposal tax has been paid to date. So you can record that there. And then finally, as with any investment pot on CashCalc, you can then dictate the growth rate of that particular pot going forward. So we're going to say 4%. Now, ETF UCITS is almost entirely identical to this. Same options as before. It can be jointly held or one or the other. Original investment, starting pot, commencement date, previous deemed disposal paid, and the total return. The only difference is that a UCITS or ETF can obviously pay an income. So you can tell the system down here whether you expect to get a yearly income from this product every year, either interest and or dividends. You can have both of them. So let's just assume that this investment solution will pay a 3% income every single year. And then I can decide whether that interest or dividends get reinvested back into the ETF or UCITS, or whether the interest or dividend gets paid directly into my current account or my client's current account. So we'll just say, no, I don't need to save this pot because I've already got them saved in the background. So if we have a look at our pots, we've got an ETF here for Sherlock. Type is a UCITS ETF, 110,000 invested in total. Now it's worth 120, and there are 3% dividends paid each year. And then that Zurich Insurance Bond under Zurich. Insurance type is insurance bond is the type, 100,000 invested in total, 130 valued now, growing at 4%. Incidentally, any income being paid like a dividend or interest, if you go to the contributions tab down here, it automatically gets added for you. So because I've asked it to reinvest back into the ETF, it's showing us here that the 3% dividend is automatically getting reinvested back into the ETF for us. Now, had I have not suggested to put that back into the ETF and put it into my current account, that would just say current account instead. Now that's clearly going to change our cash flow. So if we click on our cash flow tab, you've got the ETF investment down here at the very bottom. You've got the Zurich Insurance Bond in the middle there. If we go into our money in, money out, you've got a couple of options here. So you've got the ETF investment dividends. So that's kind of the slither of dividends getting paid every single year. You've also got the deficit being met by the ETF, which is that block, that pink block, to cover any expenses. And equally, the Zurich Insurance Bond is used at the very end there to cover those expenses in later years. More importantly, the taxes tab at the top will disclose all the taxes paid from that client or both clients every single year. And you can see there's a spike every 8 years with this exit tax with the deemed disposal. So the exit taxes are being taken and shown as that blue bar. For more granular detail, if you click on the yearly breakdown, the ages of 67 or 64, there seemed to be a bit of a spike in exit tax. So we'll click on 67 and 64. If we go into money in tab, you've got the dividends being paid to this client via the ETF every year. So again, gives you the calculation. Gross amount 2,000, the net amount 1,200, because 761 of that is based on the exit tax, 38%, and the calculation underneath. And you've also got an ad hoc withdrawal from the ETF to cover any expenses. Again, the gross amount, the net amount, the exit tax, which is pretty small because of that calculation down here. 38% of 47 euros is 18 euros. If we go to the liquid assets at the top here, you've also got the ETF investment. I think there should be a deemed disposal. There we go for the insurance bond. So we're not actually taking any money out of the insurance bond for this year, but you can see because of the 8-year anniversary, there has been an exit tax on deemed disposal, and £11,000 has been removed from that bond to cover that cost. The other thing to note is any contributions into a bond, you can waive that 1% insurance levy or have it included. So if I come back to my inputs and timeline, if I click on the contributions tab, add contribution. Let's add a contribution into my insurance bond. Wait for that to upload. We'll call this quite simply contribution. And then it's going to come from an external contribution. So maybe we're expecting some sort of inheritance this year, or my client is. So we're expecting maybe 50,000. And we're going to be using that to contribute to this bond. And you've just got, this is going to be a one-off as well. It's going to happen this year. So we'll just have that coming in when Sherlock 62, and this just little tick box just allows you to waive the levy. So if I don't have that ticked, the 1% will automatically be taken off, and we can show that in a few seconds. If for whatever reason I do want that waived, I can tick on that box, and the full contribution will be made. But if I now add the contribution, again, the cash flow will dynamically adjust for me. If I go back to my yearly breakdown tab, if we go back to this year, 62.59, if we look at the liquid assets. Actually, if we go into the liquid assets, there we go. If you scroll down to the insurance bond, there's 1% government levy being taken, 500. So yes, contribution of 50,000, levy is going to be 500. So actually the contribution into the bond is 49,500. But again, had I have ticked that box, that 500 wouldn't be there, and it would be the full contribution of 50,000. So that's how we now take care of exit tax and deemed disposal for insurance bonds, UCITS, and ETFs added to CashCalc. Hope you found that useful. Any further questions, feel free to reach out to our help desk.